Your father, very innovative during that time period, what was 1933 to 75, when it was illegal for U.S. citizens to hold physical gold, right? 33 to 75?
That's right. And as you mentioned to me the other day, I didn't know this, but dentists were the exceptional people across the country during that time.
100 ounces. We could hold 100 ounces back during that time period.
Nobody else.
Nobody else, yeah. So if that happens again, hopefully not, but you can store some gold. But your father found an exemption, a religious exemption. Talk about that. How did he, I'm not going to say circumvent, but he found a way to still make that possible for the people he wanted to serve?
Yeah. So bullion was illegal from 33 to 75. The justification in the 30s was that there wasn't enough liquidity in the system. So you're in the context of the Great Depression. And at the time, the Federal Reserve, who'd been around for since 1913, basically said, you've created us, but you're not letting us do our job. We need control of the money supply. If we have control of the money supply, then we can solve this problem. Right. There'll be more in the banking system. There won't be panics. There won't be runs. We can solve it all. So that was the concession, is give the keys of the kingdom to the Fed. Let them control the money supply. But to do that, they had to disconnect gold from our monetary system. They also knew that they would lose credibility in doing that with our foreign creditors. So we ended up with a two-tier system where we still settled our foreign credits and debts, rather, in gold ounces. But domestically, we couldn't own it. So they got to inflate domestically and maintain credibility internationally. Yeah. 70s roll around, and the Bretton Woods Agreement, which had been put in place in 44, which centered the US dollar in the world monetary system, it was being pressured because the gold that we had and the dollar that we had were supposed to be equivalent in terms of stature, in terms of reputation, and yet the guns and butter policies of the Johnson administration and then funding the Vietnam War, our foreign creditors thought, well, this is a joke. We'll take the gold and not the dollars. So what we did in the 70s was lobby to have the rules changed so that citizens could own gold again. Prior to that, the best you could do is own gold mining companies in South Africa if you wanted some proxy for the price. And that's not really a proxy. They're different animals altogether. The religious exemption allowed for my dad. He found an artist who would make 1 and 2 ounce gold medallions, 24 karat gold medallions, and they had scenes of Jesus feeding the 5,000 or Noah's Ark, or kind of a sampling of the Old and New Testament, right. And that fit the exemption. And we were in the bullion business in '72 with a 3-year head start on anybody in the business. So we actually started out as a wholesale business strictly to Wall Street firms who didn't have a solution for placing bullion in a client's account. And then starting in the late 80s, we started working with individual clients as well. But yeah, the religious exemption was everything. It gave us a first mover advantage in the gold market.
So while we're on the topic of gold and precious metals, let's dig into that a little bit, because I think there's a lot of us, we think, well, it would be good to hold some precious metals. Not always sure how to do it, how much to allocate. Liquidity issues, we talked about some of that this morning. So let's go down that rabbit hole a little bit. And I know that's not all you do. So maybe the reason I love having David here is because you can tell he has a very holistic approach to really everything in life. And if we're talking about finances, yes, your father, the business, made a market there. That's only one thing that you do. You look at a broad spectrum. So, but let's talk a little bit about where precious metals might fit into a portfolio a little bit in that regard.
Yeah, for context, we're interested in all markets, and the businesses that we run today, one is an asset management company focused on hard assets in the publicly traded markets. So our focus is specialty real estate, infrastructure, global natural resources, precious metals. So diversified portfolio of equities in those areas. I mention that because we're not a one-trick pony as it relates to the precious metals themselves. To manage a high beta portfolio in those spaces, meaning you've got above average volatility in those kinds of stocks, we have to focus on risk management every day. So I've got a great team, and we look at the internal workings of the financial markets and talk about it constantly. Are we supposed to adjust our liquidity, increase, decrease, et cetera, to manage risk in the portfolio? We arguably have a higher volatility portfolio. Last year we didn't lose any money versus the market, which was obviously upside down, Dow, S&P, NASDAQ. But it means that we're engaged with lots of inputs, whether it's interest rates or credit default swaps. All of these things matter to us. Precious metals, that's been our business going back 50 years. Asset management, 15. The metals business is really like, it shouldn't exist, honestly. If we had sound money, it wouldn't need to exist. Like because going back to the 19-teens and 20s, all gold was money, right? So you had your store of value. When you sold stocks or sold real estate and put money in the bank, it was sitting there in the form of gold, right? So that's what it was. Now we've come to believe that it's some sort of a commodity speculation and that greenbacks have greater value than gold ounces. It's a really interesting transition and evolution that we've gone through in our thinking on metals. So gold should be cash. As it turns out, in this age of inflation, it's more of a hedge. And so it serves as a hedge against stock market volatility. It serves as a hedge against inflation. The best research actually shows that it's a better hedge against deflation. It does nothing in real time for inflation. It has these sort of fits and starts. It plays catch up to inflation. So you might be looking and saying, well, it's not really keeping up with inflation. It might do that for a year. It might do that for 18 months. If you look at a decade by decade view, it's tracking inflation. It just does it again in sort of a...
For spurts, yeah.
In spurts.
Well, like this last year. People say, well,
Yeah.
gold didn't do very well. Yeah, but how are you looking at it, right? What's your perspective on that?
Yeah. So a lot of clients will look at it as a hedge to manage sort of overall risk. A lot of clients see it as a way to maintain liquidity. Mm-hmm. So, and I think that when you look at the metals, the best way to view them is like a golf bag. There's different clubs in the bag, and there's different ways to approach it. It just depends on what you need at the time. Like physical gold in your possession, that's kind of like the sand wedge. You don't want to be in the sand wedge. You never want to have gold that you might use for barter or for some sort of worst case scenario. But you have the sand wedge anyways, because if you get stuck, you got to get out. There's other ways to approach it that are more dynamic, and we do a lot of ratio trades and premium trades that allow us to grow the total number of ounces in a portfolio without new money coming into a portfolio. So it just depends, what is someone wanting? How do you get it? So our engagement with clients a lot of the time is just listening and figuring out, what are you trying to accomplish? You've just gotten out of a real estate deal and you've got too much money in the bank. Liquidity is an issue. You don't like inflation.
Can't find the next deal.
Yeah. So if you're stuck for 3, 6, 12 months on the sidelines, like our Vaulted program, Vaulted.com is it's like our cash alternative. It's a banking alternative. It's in ounces instead of greenbacks. It just like, what's the problem we're solving for, and there's a different approach. So I would happy to engage with anybody on those kinds of things. But gold at the end of the day is a hedge. The IMF just wrote a paper, published it at the end of January, and they said, look, we've got these uncertainty events that are causing central banks all over the world to add gold to their holdings. Last year, there was more gold added by central banks to their balance sheets than in any other year going back to, I think, 1956. They were buying hand over fist. Why? Economic uncertainty, financial market uncertainty, geopolitical uncertainty. And the language they use is, we have these uncertainty events. The reserve managers look at it and say, we should really be adding to that part of our portfolio.